Imagine investing as a wild ride in a thrilling theme park. Many traders are drawn to the flashy stocks that promise quick riches, akin to daring rides that make your heart race. These investments can feel exciting, but their ups and downs are as unpredictable as a roller coaster. However, seasoned investors and financial experts often point out that the true value lies not in these headline-stealing stocks. Instead, it's in the quieter, more understated world of index funds, which are often the unsung heroes of a smart investment strategy. You might wonder, what is an index fund, and why do so many experts recommend it as a savvy investment choice? Let's explore this concept together and uncover why it's often considered a wise option for building wealth. An index fund is an investment vehicle designed to mirror the performance of a specific set of stocks or bonds, known collectively as an index. It's like capturing a snapshot of the market's health, giving you a sense of the overall economic climate. Think of an index as a leaderboard, much like music charts ranking top hits. But instead of songs, it ranks companies by performance, allowing investors to see who the consistent players in the stock market are. A popular index many people follow is the S&P 500. You can think of it as a prestigious hall of fame featuring 500 of the most significant and influential U.S. companies, showcasing the economy's giants. Index funds invest by holding the same stocks as the index they track, letting you dip your toes into a wide array of companies simultaneously. This helps in spreading your investment across the market, much like casting a wide net. One might wonder, why choose an index fund? The answer lies in a fundamental investment strategy known as diversification, which acts as a safety net in the world of finance. Consider diversification like not putting all your eggs in one basket. By spreading your investments out, you protect yourself from potential risks, reducing the impact should any single company falter. With an index fund, you essentially own small pieces of many companies. This broad exposure can protect your total investment should one company start to underperform or even fail, acting like a financial safety net. This strategy contrasts sharply with the risky business of picking individual stocks, which often feels like gambling. It can lead to emotional highs and lows, making it a more stressful financial journey. One of the most significant advantages of index funds is their cost effectiveness. They generally have lower fees than funds managed by professionals who actively select stocks, which saves you money over time. But why are the costs lower? It's mainly because index funds don't require expensive managers to pick stocks. They simply follow the index, which means fewer expenses for you to cover. By automatically following an index, these funds cut out the high costs of active management. This translates to more savings for you, meaning a larger portion of your investment can continue to grow. With lower fees, more of your money remains invested, allowing it to grow and compound over time. It's much like tending to a garden, where seeds planted today can bloom into a vibrant array of flowers over the years. Here's where being boring works its magic. Over the long haul, history shows that index funds often outperform actively managed funds, proving that patience can indeed be rewarding. Even seasoned investors struggle with timing the market perfectly, which makes the steady growth offered by index funds so appealing. They offer a reliable path to build wealth over time. Picture a dartboard with slices representing different companies. With index funds, you don't need to hit the bullseye to win. Your investment is spread across the board, reducing the need for precision. Let's dive into how everyday investors like you and I can start with index funds. It's a journey that can help nurture and secure our financial future, step by step. The first step involves choosing a brokerage platform where you can purchase index funds. This is similar to setting up an online bank account. It's convenient, straightforward, and opens the door to investing. Once your account is up and running, the next move is selecting an index fund that aligns with your financial goals and long-term plans, making sure it fits your personal aspirations. Some investors prefer funds tracking broad U.S. market indices, while others might look at international options, tailoring their investment strategy to suit their individual goals and preferences. Consider your risk tolerance and the length of time you plan to invest. These factors are crucial in guiding your decision, helping you choose an index fund that matches your financial comfort zone. Index funds are especially well suited for long-term objectives, like saving for retirement or creating an education fund to support your children's future aspirations and needs. After selecting an index fund, decide how much money you want to invest and how often. Regular contributions can work wonders for building up your investments over time. A popular method is dollar cost averaging, where you invest a fixed amount at regular intervals, no matter how the market is performing, which helps smooth out your investment over time. By not investing all your money at once, you reduce the risk of entering the market at a bad time, similar to placing multiple small bets rather than one big one to minimize potential losses. It's important to remember that investing isn't about racing to quick riches. It resembles running a marathon. It requires patience, endurance, and a focus on the long-term finish line. Index funds perfectly encapsulate the patience needed for solid returns over time, much like watching a tree grow from a tiny seedling into a towering oak through the seasons. Reinvesting dividends back into your fund can significantly boost your returns. This reinvestment leverages the power of compounding to enhance your wealth incrementally over time. If you're unsure about index funds, think about your financial targets and the timeline you have to reach them. This reflection will guide you to make an informed and confident choice. Remember the fable of the tortoise and the hare? In the world of investing, slow and steady often wins the race to financial success, teaching us that patience is indeed a virtue. So next time someone brags about a hot stock tip, take a moment to appreciate the power and dependability of boring yet stable investments like index funds. They are often the smarter choice. In the end, the smartest way to build wealth is often through a simple, diversified strategy. It might seem a bit boring, but it's usually the most effective approach in the long term. Embrace the potential of index funds to keep your financial journey straightforward and effective, helping you build wealth consistently over time with minimal stress and fuss. Thank you for joining us today. Be sure to subscribe to our channel for more insights and tips on smart and savvy investment strategies to help you grow your wealth effectively.